All right, I think we're good to start then, and hopefully we're kind of at the number of most folks that will be in the session. So, welcome to the March Revenue Roundtable. This one is on tax expenditures, which I find to be an incredibly interesting topic, and I think one that we sometimes talk about in a wonkier sense than is needed. So we're going to boil it down to some basics and make it a fun time. All right, let's get started with the first slide if we can. So, tax expenditures one-on-one. Looking at the chat, I know that we might have some experts in the room with us, but before we get to the juicy stuff, let's start off with the basics. And so, what are tax expenditures? You can think of tax expenditures as a fancy way of saying special tax breaks. They lower the liability of a person, business, or other entities. And tax liability, by the way, is the total tax owed to federal, state, or local governments. It's calculated by like taxable income times tax rate minus basically the tax expenditures, the tax credits, deductions, et cetera. That equals the tax liability. A tax expenditure can take the form of tax exemptions, exclusions, deductions, credits, deferrals, allowances, reimbursements, and preferential tax rates. And while they can play a useful role in making Ohio's tax code fair, tax expenditures also reduce revenue. So every dollar not collected because of a tax break is a dollar we can't invest in public goods that Ohioans rely on. Lost revenue means that lawmakers must either cut services, shift costs onto local governments and taxpayers, or forgo opportunities to strengthen Ohio's economy and communities. So it's important to ensure that tax expenditures are appropriate, transparent, and effective. Next slide. So, tax expenditures as policy instruments. Essentially, tax expenditures are government spending programs. They're just delivered through the tax code instead of direct payment or program funding. How does that work? With a traditional spending program, the government simply sends money out. It might be a check, benefit, payment, or direct funding for a service. But with a tax expenditure, the government provides the same support by reducing someone's tax bill. Instead of giving you a business entity, et cetera, the payment, it allows the groups to pay less in taxes. Next slide. So let's talk about how this works through an example. Let's say the Ohioan government has been like, it is so windy. We have to capitalize on all of this wind. Let's build some windmills. They could either create a direct spending program to subsidize windmill constructions, or they could offer a tax expenditure that lets companies build windmills by reducing their taxes by exactly the same amount as what the spending program would have offered. So in theory, it doesn't matter whether a government uses direct spending or tax expenditures to achieve a policy goal. In either case, the windmill subsidy program will, in theory, have to compete with other government spending priorities when the government makes its budget decisions. Next slide. So I said in theory, tax expenditures have to compete with other government spending priorities when the government makes its budget decisions. And you might ask, why in theory? The tax expenditures benefit from a political advantage because they can be framed as tax cuts instead of spending. Supporters of targeted industries favor them since repealing a tax break looks like raising taxes, making these subsidies harder to eliminate. They often avoid normal budget controls. Many are open-ended, cost caps, making these subsidies harder to eliminate. They often and key data needed to evaluate them is frequently hidden due to taxpayer confidentiality rules. So these biases make tax expenditures popular, but can lead to costly, under-reviewed subsidy programs, highlighting the need for reform. Next slide. So now that we understand the basics, let's get into tax expenditures in Ohio. Next slide. Every even-numbered year, the Ohio Department of Taxation must prepare a tax expenditure report by November 1st. And this is not accessible to the public at this stage. It's then sent to the governor, who is then required to submit the report to the General Assembly as an appendix to the biannual budget And you can find this once it's kind of out in that way in the Blue Book. This is usually published and like accessible to the public, like late January, February. But since it's an election year, you can probably expect this in like March of next year for the next tax expenditure report. The report lists each tax expenditure and estimates the general revenue fund foregone for the current and next biennia, so the next 2 years. And so we can head to the next slide. Ohio law, tax expenditures, by the way, can be defined differently depending on kind of what you're looking at. So differently depending on another state, another report, kind of at the federal level. But Ohio law, within its kind of tax expenditure report, defines tax expenditures as any tax provision that exempts certain people, income, goods, services, or property from state taxes, including deductions, credits, exemptions, exclusions, deferrals, allowances, reimbursements, and preferential tax rates. Unlike direct spending programs, tax expenditures often remain in the law indefinitely unless they have a built-in expiration date. And the GA, or the General Assembly, does use the budget to change some tax expenditures, but what exactly the methodology and logic is for picking certain exemptions or expenditures versus others to address is a little bit cloudy, and we'll get into that later. Next slide, please. So I'm going to walk you through what we kind of found in the most recent tax expenditure report, which is for financial year 2026 and 2027. But we do encourage you to kind of read it as well as look through past reports if you're interested. So if you're curious, you can scan the QR code to read the most recent report, or you can use these instructions to access previous ones. The slides that we're using today will be shared out later, so you can kind of go back and look through this in your own time as well. Next slide. So this is kind of, again, information pulled from the report. As of June 2025, the state had 177 tax exemptions. And these, or tax expenditures, these expenditures were estimated to cause the state to forgo an estimated $12.51 billion in financial year 2026 and $12.96 billion in financial year 2027. That's an increase of $410.9 million between financial year 26 and 27. 69 of these expenditures were valued at more than 20 million over the biennium, 58 were valued at between 20 to 1 million, and 50 were valued at less than 1 million. Next slide. So this is looking at the types of exemptions. As you can see, sales and use are the most common and the most expensive. And 42% of the type, this is, by the way, how like the tax department codes what type of exemption is. So this is kind of from their methodology. 42% of the exemptions classify as kind of sales and use. Commercial activity counts for 32%, personal income is 15%, and other is about 10%. Next slide. So back when tax expenditure reports were coming out under, I believe, Governor Strickland, there was further coding done to look at kind of who the beneficiaries of certain tax expenditures were. I believe that part of the methodology is no longer a thing in the current tax report. So within the Shortchanging Ohioans report, which looked at the most current tax expenditure report, we used for the kind of existing expenditures at the time, we coded them the same and then had to figure out how to code new tax expenditures for to be looking at who the beneficiary was. And we divided the beneficiaries by business and economic development, individuals, and public and nonprofit sectors. So 109 out of 177 expenditures benefit business and economic development. These breaks will see the state forgo an estimated $16.42 billion in financial year 2026 and 2027. And this accounts for 64.5% of the estimated total $25.44 billion in foregone revenue over the 2-year period. 1.64 billion, there's a $1.64 billion growth between financial year 2024 and 25 and this kind of biennium. So that's looking at the business and economic development. Next one. For tax breaks for individuals, 61 out of 177 tax breaks benefited individuals. These tax breaks will see the state forgo an estimated $5.97 billion in the biennium, and then it accounts for 23.5% of the estimated 25.44 billion in foregone revenue over the next few years. Of this amount, 2 billion or 27 breaks support health and education, while 3.9 billion or 34 breaks go towards individual tax benefits. And as you can see, this one also had a growth between the last kind of budget cycle and this one, but substantially smaller than breaks for businesses' economic development. And so last one for this. And then tax breaks for public sector and nonprofit. So 7 out of 177 breaks benefited the public sector and nonprofits. These breaks will see the state forgo an estimated $3 billion in financial year 2026 and 2027, account for 11.8% of the estimated total 25.44 billion in foregone revenue over the 2-year period. And again, this one has seen some growth between the last budget and this one, but smaller than businesses and smaller than the one for individuals. So we can now see what this looks like as a visualization in the next slide. Yeah, as you can see, businesses are the most common and costly beneficiaries. And if you want to read more around this, I would encourage you to check out our Shortchanging Ohioans report, for which we will have a QR code at the end. Next slide. So I wanted to talk about one of the changes that was made in the most recent tax expenditure report that we welcome and hope to see kind of more of. So this is the first tax expenditure report to include property tax expenditures, bringing together information that was previously scattered across multiple documents. The report showed rapid growth in local economic development exemptions, rising from 48.26 billion in taxable value in 2020 to 69.5 billion in 2023. The scale and pace of this increase underscores the need for stronger guardrails on local tax abatements. Next slide. So again, the tax expenditure report covers 177 different tax expenditures. Let's start by looking at the top or the largest 20 tax expenditures in 2026 and 2027. Next slide. So looking at this, you'll see that the top few go to kind of a different host of beneficiaries. Property used in primarily manufacturing benefits businesses. The Ohio business income deduction is one for individuals. And then kind of the third one references the commercial activities tax, and that's businesses again. But you also have like sales to churches and certain types of nonprofits, as well as the sales exemption on prescription drugs and selected medical supplies. That's to say it's somewhat varied in terms of how and who these are going towards. But again, for the top 20, you see the beneficiary being businesses still largely being true. Next slide. So this is a continuation of that list. I included this because I wanted folks to just look at the end. So the sales of qualified property used in eligible computer data centers. This is a growing tax expenditure and one that has a lot of buzz around it at the moment. Ohio exempts qualifying data center companies from paying sales taxes on construction materials and computer equipment that these facilities use. And these data centers often have kind of local property tax abatements as well. So they're not paying up to kind of 75 to 100% in property taxes for 15 to 30 years at times. And so this was a tax expenditure that had bipartisan support for repeal during the last budget cycle, but was ultimately vetoed by the governor. And we'll get a little bit more into that. But that's to show that this is a growing one and within the top 20. Next one, please. And so let's zoom in on the 3 largest expenditures. And so the top 3 largest expenditures are property used primarily in manufacturing, the Ohio business income deduction, and the exclusion of the first $3 million in taxable gross receipts for tax year 2024, and the first $6 million in taxable gross receipts for tax year 2025 and beyond. If you don't know what that means, we're going to go into it a bit further, so don't worry. But I think it's worth understanding for the ones that just have the largest monetary value, how they function, who they benefit, and some of the some of the politics behind it as well. All right, next slide, please. So Ohio's largest tax expenditure is the sales tax exemption for goods purchased primarily for use in manufacturing. This and other business input exemptions are designed to prevent tax permitting, where the sales and use tax would otherwise be charged multiple times as the product moves through the production process. Business inputs means like there are human, physical, and financial resources needed by the business to produce goods and services. So by only taxing the final sale, the system avoids compounding costs through the supply chain. This one is generally fine. It is the largest, but I think there's like some changes that might be made, but I think it's generally a fine exemption. Next slide, please. And so the next one is the business income deduction. Business income can include income from sole proprietorships, farming, or a pass-through entity. A pass-through entity are entities that pass profits on to the owners. And so this is often how a lot of businesses in Ohio are set up, specifically through like an LLC structure. The business income deduction, or the LLC loophole, allows individuals to deduct up to $250,000 of business income, and has become Ohio's second largest tax break, not counting. So this is a little bit that's been crossed on red. I'll get into it, but it's become like Ohio's second largest tax break. So the LLC loophole gives substantial tax break to business owners, allowing them to pay no taxes on the first $250,000 on their business income. Previously, there was this 3% rate that used to be in place that they would pay for income above that 250,000. But the top rate up until last year was 3.25%. And so as that's been dropped down to 2.75%, the preferential rate doesn't really exist anymore. You're actually paying a little bit more through this particular policy than, made sense previously. And we can kind of get into questions at this at the end. The benefits were concentrated at the top. In FY 2023, just 8.3% of filers who were deducting 240,000 or more claimed 41.1% of the total value, while most filers deducted just under 20,000, receiving only 6.9% of the. Let me read that again. Yeah, in FY 2023, just 8.3% of filers claimed 41.1% of the total value, while most filers deducted under 20,000 and received only 6.9% of the total value. For typical claimants, the deduction was too small to meaningfully affect hiring. A $20,000 deduction lowers taxes by only about $700 at last year's top rate. So this is an exemption that has primarily benefited wealthy individuals. Next slide, please. And so this is just a look at how that kind of looks. And as you can see, the number of filers for this is it's kind of skewed, where the larger share is for this like larger amount, but there's a smaller share of return. So that's just to show kind of how lopsided it is and how wealthier individuals benefit more from the LLC loophole. Next slide, please. And so the next one we're focusing on is the commercial activities tax. The commercial activities tax is Ohio's broad business tax levied on total gross receipts and serving as the state's alternative to a corporate income tax, although it brings in significantly less than the corporate income tax brought in. Lawmakers drastically reduced the CAT tax into the 2023 budget by raising the filing threshold from 1 million to 3 million, and in 2024 and beyond 1 million to 3 million in 2024 and 6 million afterward, while also eliminating the minimum tax tiers. These increases effectively eliminate CAT liability for most businesses, since 71% of Ohio filers had under 1 million in taxable gross receipts in 2023. And these changes mean that fewer than 1/10 of Ohio businesses now pay the CAT, effectively turning it into the state's third largest tax break. Next slide. And so those are like the top three largest tax expenditures. And for number 2 and 3, I think there's significant needs to kind of rein both of those in and actually ensure that Ohioans, who benefit, who typically tend to be the wealthiest, are also paying their fair share. And so now we're going to look at changes since the 2024 and 2025 tax expenditure report. Next slide, please. In the tax expenditure report for 2024 to 2025, there were 154 tax breaks. In 2026-2027 report, the most recent report, there were 177. So 23 tax expenditures were added and none were eliminated between the 2023 budget to just before. None were eliminated through the kind of 2023 budget, and 23 were added in the time to the most recent budget. So next slide. These 23 new breaks will cost the GRF about $285.6 million in revenue. This doesn't include expansions for existing tax breaks, such as the sales tax holiday and exclusion for CAT receipts. If you've kept up with the property tax news that came out in December as part of HB 186, the expanded sales tax holiday was actually changed or kind of canceled. And it was to typically allowing like broad tax repurchases of items up to like $500. The revision is now that we're going back to like a traditional 3-day back to school sales tax holiday in August. And this change was to fund the money that's being saved is being repurposed to fund the property tax reductions and protect school district funding that have been kind of changed as part of HB 186. And so some of these expenditures change over time to also address kind of additional costs that come up through kind of legislation through the year. Next slide. And so before the budget, as I said, we had 177 exemptions, and there were some changes made during the budget that I think are worth highlighting. Next slide. The General Assembly eliminated or reduced 9 tax expenditures in HB 96, worth a total of $325 million to the GRF during the financial 2026-2027 biennium. And so this only includes those with a fiscal effect of at least $1 million a year. Next slide. And in the same budget, the legislature also added or expanded 6 tax expenditures. And that was worth a total of $95.4 million to the GRF. So what they eliminated was more than kind of what they added. So there was actually some revenue kind of saved through this process. Next slide. And Governor DeWine vetoed 6 tax expenditure change proposals, which included 5 expenditure reduction proposals and 1 new expenditure proposal. And I'm just going to get into the highlights for some of what that included. So he vetoed the repealing of the sales tax exemption for newspapers. And so newspapers are exempt from the sales tax, and that was something, again, that a lot of folks rely on for their information and whatnot. So that's one I think was kind of a broadly good move. He also vetoed the creation of the educational saving account program, which would have allowed students attending non-chartered, non-public schools from receiving state funding for tuition and other school expenses. It was cited that this one in particular was repealed because there was a lack of evidence in terms of non-chartered, non-public schools and how they performed. And then for number 3, he vetoed a budget provision that would have disallowed additional data centers from receiving the sales tax exemption. And that's what I talked about. This had bipartisan support. And it wouldn't have kind of meant that we would be saving the full 200 something million from that, but it would have disallowed new data centers that are being built from getting that sales tax exemption. And so, although that's been vetoed, I'd like to point out that the General Assembly could still override that veto, and has the time to do so at the moment. I believe it's been in the news that although they haven't pursued that yet, there is a chance that they might come back in April and look at that again. And so, next. This is just a summary of what the changes look like. So there were 177 tax expenditures before the budget passed. The budget eliminated 9 and 6 were added. So after the budget was enacted in July, there were 174 tax expenditures that, we can kind of track through the report and the budget specifically. Next slide. So the budget is often used as a place to change tax expenditures and review them, but the process for it is not as robust as it should be, which is something that a tax expenditure review committee could kind of step in and help with and be doing stuff around kind of more year round. And we had one in Ohio up until I believe 2023. So we're going to look at what that tax expenditure review committee looked like and what they did well, what they didn't well, and recommendations to kind of make or install a new one. Next slide. So in 2016, Ohio created a tax expenditure review committee through HB 9. It established a permanent joint legislative committee made of 6 lawmakers and the tax commissioner to periodically review all existing tax expenditures. It required the committee to recommend whether each expenditure should be continued, modified, or repealed, and it mandated that any bill or changing a tax expenditure must include a statement explaining the purpose and policy intent. And on the slide is the actual language from the bill's final analysis. And if you're kind of interested, you can visit the source in there as well that just looks at kind of some of the more nitty gritty around what that committee was supposed to do. Next slide. And so the committee had good bones in terms of what it was trying to do. Some of the responsibilities it had included considering who directly benefited from tax expenditures, including individuals, industries, or specific organizations, evaluate the fiscal impact on state and local governments over time of a tax expenditure, along with the policy goals and legislative intent behind the break, assess whether the intended goal could be met through other means at lower cost, or identify unintended advantages or benefits, examine the potential negative impacts on current beneficiaries if the tax expenditure was eliminated, as well as the broader economic or employment effects, and then determine how feasible it would be to modify tax expenditures and recap the funds when recipients fail to meet their intended goals. And if you click on the report again in this source, it takes you back to a 2018 report that we published, kind of looking back at that committee, what went well and what didn't. And it includes like the top 10 criteria for evaluating tax breaks that it used. Slide. Lawmakers eliminated this committee in the 2022-2023 budget. The committee reviewed only 15 sales tax breaks, and for 8 of them, worth a combined $1.7 billion annually, no proponents testified in support. Despite the lack of justification, including for these 8 that had no one show up to defend the breaks, the committee still recommended continuing every one of these tax expenditures without modification. Given the absence of supporting testimony, the committee should have recommended immediate repeal of such unsupported tax breaks. Next slide. And so we currently don't have a tax expenditure review committee, and I think the intention should not be to bring it back as it was, but to make it better. And I think we can learn from other states in terms of how they've done it, and also then adjust it for what we need in Ohio. Next slide. So I'm not going to read through all of this, and I encourage you to kind of go back and look through this or read our Shortchanging Ohioans report, which actually walks you through this as well. But I'm going to just talk about this through the summary. We're focusing on 5 states here: Virginia, Pennsylvania, Washington, Colorado, and Texas. And you'll notice that they have kind of their different versions of committees, but Could we go to the next slide after the next one, Kate? But what we can find is that there's some overlap in the things that they do that make their committees a little bit more effective. There's requiring an annual and biannual reviews of all tax expenditures to review consistent oversight. Again, our tax expenditure review committee reviewed just 15. Appropriating proper committee funding. Our tax expenditure review committee did not have funding. And employing full-time economists and analysts to support high-quality, nonpartisan evaluations. It's good to have a mixture of legislative staff, but I think having the actual support of economists and other kind of groups to call in other states has been part of the reason that they've been able to judge kind of efficiency, learn from other sectors, and actually have an idea of, if it is actually meeting the intended goals and outcomes as well. Include estimated and actual costs, administrative burden, economics impacts, and number of beneficiaries and cost effectiveness. Review legislative intent, intended beneficiaries, and whether the expenditure is achieving its stated goal. Analyze who benefits and who bears the cost, accounting for racial equity and tax incidence by income level. The tax incidence bit is really interesting because I believe Texas was the only state of the 5 we reviewed who actually does this. And so that's looking at kind of a tax expenditure, who by different income groups is actually benefiting. Benchmark against similar policies in other states, assess alternatives, and provide clear recommendations for improvement, modification, or repeal. Next slide. So there's a lot we can do to change how this committee works. And this is just a starting point of these are things that other states are doing that are working. There's obviously some stuff that we can take away from our previous committee, but I think it is clear that we should and need to have a new tax expenditure review committee. And I want to make clear how this is different from the biannual expenditure report and why we need both. So the biannual tax expenditure report is a brief description of the tax expenditure, categorization of the expenditure revenue foregone in the past 2 fiscal years. All in all, it's kind of the plain fiscal information with a very brief description of the expenditure. The biannual tax expenditure review committee would decide whether a tax expenditure achieves its intended goals, is fiscally responsible, benefits the right people, and most importantly, should continue. And it would have kind of that panel of experts as well that would be able to weigh in and actually require, new tax expenditures to provide a reason for why they should exist. I think with the introduction of such a committee, all tax expenditures should be in a way sunsetted and forced to kind of justify why they should continue and go through the cycle every 5 years or so. And we can kind of phase in maybe which tax expenditures are done in which years, so there is some level of doing it in stages. Next slide. And so I don't know about y'all, but it is spring cleaning time in my household, which means that we're looking through what we are keeping and what we're getting rid of. And I think this is a perfect time to do the same for our tax expenditures. Next slide. So it is never too late or early to think through tax expenditures to trim, tighten, or toss, and what to keep. Slide. So this is our list of trim, tighten, or trash. And so first is to reduce the business income deduction. That is the LLC loophole. There is kind of a number of changes that can be made, and I think maybe Zach would want to get a bit more into it at the end. But to start, we should take the deduction level, I think, a bit down, and then lower the threshold for businesses to pay the CAT. Currently, it's at 6 million. Again, a majority of businesses do not end up paying the CAT for the level it's set at. So we should at least bring kind of the threshold back down, rein in the tax break for building and construction material for certain construction. This is, of our neighboring states, we're the only one to have this exemption. And we have a really weird carve out that if you want to hunt deer and you enclose them in a structure, you can get a tax exemption for that, which is just to show like how many weird carve outs we have for certain tax exemptions. I don't think that's one that's needed. Eliminate the special interest loophole, eliminate the sales of qualified property and data centers, eliminate, and it should say the expanded sales tax holiday there, which we have kind of done in a way. Eliminate horse racing taxes and purse exclusion. It goes on. There's a couple here that are just really fun and just show how mixed kind of what these different tax expenditures are and who they benefit. We have a sales tax exemption if you have a timeshare in a private jet in the state of Ohio, in a certain company, I believe like NetJet. That's typically the one that's benefiting. But do we really need to be giving, an exemption for folks who have a timeshare in a private jet? I think that's kind of silly. But that just shows how varied they are. Next slide. And I really want to emphasize that not all tax expenditures are bad. Many of them also do help everyday working Ohioans, and we should keep a list, an idea of the ones that do and how they can kind of work for us even better or make sure that we don't lose track of them. Exempting the sales tax from prescription drugs, the state income tax credit, earned income tax credit, the homestead exemption. These are just some that, again, benefit a lot of folks and is more just to show that not everything needs to be cleared out of the house. We want to keep the house cozy and keep the house livable. Next slide. And then we have a wish list, right? If we clear some stuff out and we have some spare change, or a lot of spare change, there's some new policies that we'd really like to see in the state of Ohio that would help working and everyday Ohioans, I think, thrive. So the property tax circuit breaker is a hot one at the moment, as there's been a lot of property tax debates. The property tax circuit breaker would allow us to provide targeted property tax relief to the Ohioans that need it the most by providing a state tax credit to people whose property tax bill exceeds a certain percentage of their income. The percentage of their income can be set at a certain level. The tax credit issued back can be set at a certain level. It can be staggered. It's highly flexible. 29 states have a property tax circuit breaker, both red and blue, and this is something that is attainable. Refundable earned income tax credit. We currently have an earned income tax credit, but it's not refundable. So if you make under $26,050 and you're not paying taxes, the earned income tax credit lowers your tax liability. But if you have no tax liability, you're not really benefiting from this. And so this would be able to actually issue a tax credit to the lowest earning Ohioans and help them and their families. The child tax credit and the sales tax credit. We have a wish list of things we want to do, and with the revenue to do it, I think we could make Ohio a thriving state. It's really important to remember as I come to an end that eliminating certain tax expenditures, if you see like a number in the revenue foregone, eliminating certain tax expenditures will not give you a one-to-one in terms of the expenditure or the kind of revenue loss recorded and what you would get. And this is for a number of reasons, including like for the data center tax exemption. There's certain agreements that we have with data center companies. And so we, cannot, I think, easily exit a lot of those agreements. That some of that expenditure would remain, but we could prevent new companies from entering agreements. And so that kind of wraps up our revenue roundtable for tax expenditures. And we'll take questions now.